Here are your top 6 alternative investment ideas for your portfolio. First off, why alternative investments? Well, they provide phenomenal returns, real diversification, uncorrelated assets, incredibly tax-efficient return, and it's not stocks and bonds, which means that provide much more stability in your portfolio, and it's usually agnostic to what happens in the market. So that's why we own alternatives. Now let's look at the top 6 alternatives that you can put in your portfolio today. The most easy one, the one you've heard of, is private real estate. Now this could be a whole bunch of different asset classes in itself, but if we focus on real estate as one major asset class, typically our focus is always on multifamily residential. That will include apartments, condos, townhouses. They're rented. It's very recession proof. If people lose their jobs, they typically will lose their homes, which means they're now renting. It's not great. I know it's a bad concept to think of, but it's a safe asset class in that front. The risk is obviously that your rentals are not rented out, but you could always lower your price. And usually real estate appreciates in value year in, year out. So it's a phenomenal long-term investment holding, a great holding for a long-term asset such as your RSP, your TFSA, or a non-registered account because it is that tax efficient. The income generated from private real estate is typically classified as return of capital, ROC, and ROC is not taxed in the year it's received. So private multifamily real estate is kind of the main class in real estate, but there are others. Student housing is another one. You can get commercial, you can get industrial, you could even get office or retail. Those are other classes of private real estate. Our focus is typically on multifamily because it's way less risky, way less volatility, much safer asset, much safer income stream. Number 2, private infrastructure. Private infrastructure, much like private real estate, is an asset class where you own the underlying real asset, in this case, bridges, toll road, airports, energy projects, solar, hydroelectric projects. These are all projects that have a long-term life. Typically, governments or big corporations will pay a third party to build this thing so they don't have to keep it on their balance sheet, right? So if you build this thing, you're going to finance it, you're going to take care of it. We then just rent it from you. And it's a lot cheaper for us. We need less capital. It's cleaner on our balance sheet if we're a large corporation or a government to rent it. And we don't have to raise capital. We don't need to issue bonds. So a lot of times the governments are happy to pay a premium in terms of return for a third party to build these huge infrastructure projects and then rent them right back to us. A lot of times these infrastructure projects are only having one tenant and it's a very long lease, 20, 30, even 50 years. Some of these even have 100-year leases. So the revenue stream is consistent. The tenant is usually top notch because it's usually a government or a very strong company. And the revenue stream usually increases in predetermined increments. And there's usually a fail-safe in place for the owner of the real estate asset in the eventual change of macro terms or macroeconomic terms that would impact the project. So it's a safe asset, generates return, it's agnostic to what's happening in the market, and it's a real asset, which is a great hedge against inflation. Next, we're going to talk about another type of real estate. It's a little different. Number 3, private storage. All right, so this is mom and pop shops that have storage units that are getting out of the business and someone's coming in, consolidating and buying those. Maybe you've seen them before and maybe you rent a storage unit. You're paying $200 a month for an 8x10 and you go once every couple months and you put your junk in there and you're paying rent to the owner of that land and of that property in order to get that small piece of real estate. It's a form of real estate, but it's a little bit different and it's an emerging area and it's a way that you can invest now. The reason we like it so much is because it's in such a growth industry. Emerging middle class, more and more Canadians, Americans, more and more individuals have the wealth, the ability to pay for a storage unit, more and more junk, more and more stuff your kids have that you don't want to throw away, and that ends up in a storage unit. And it's more and more acceptable now to pay for a storage unit, to add it to your monthly expense, and once it's on there, it's likely staying on there forever. So it's a fast growing area. It's a great place to generate consistent, safe returns, and again, it's very tax efficient to receive the income as return of capital. Number 4, farmland, another type of real estate. This time's a little different in that farmland is a play on agriculture. It's a play on the expansion of the middle class in other countries and the consumption of protein, typically in the form of, meat. And if you're consuming meat, that means those animals need to eat. They need to eat corn and soy and canola and whatever else they're eating, which means we need more and more farmland to feed that protein that we're eating. And there's more and more population, less and less arable land. So it's a supply and demand imbalance. We believe the next 20 years will be very good for farmland because more and more people, less land, and we're more and more concerned about what we're eating. Therefore, the end play there, the more there's inflation, the end play goes down to the farmland, right? Eventually the inflation makes its way down to the farmland. It starts at the dinner table, it makes its way down the supply chain, and eventually the land that is producing this corn, this wheat, this canola will start to appreciate in value. Now there's no operating risk. We don't want to be running farms. We simply want to own the underlying asset, rent it back to the farmer, reduce the risk, and just collect the distribution for renting the land. And that's a way that you can participate as a Canadian investor. You can participate in farmland. Number 5, music royalties. You've probably never heard of music royalties as an investment asset class, but it's a good one. So think of every song catalog that's ever been created. Somebody owns the rights to that, and they can sell their catalog. They could sell their rights. And with those rights comes an income stream. So you get a cash distribution every time tunes get played on Spotify, on Apple, in a video game, at a movie theater, at an arena. Every time these songs get played, there's a revenue stream that's created. And that revenue stream eventually makes its way to the owner of the rights to that song. Normally that's the artist, but it can be someone who purchases the rights to that song. Think of an artist that wants to retire, wants to cash in on their catalog. They would sell their catalog to an investment firm or to a fund, and then that fund owns the future revenue stream for that song, for that catalog. The neat thing about this is that streaming music is a fast-growing industry. So if you're buying a song today, yes, you get the current revenue that it's generating, but if that streaming revenue grows over the years, you get more and more revenue. And if your revenue from one song goes from $10,000 to $15,000, well, you've dramatically increased the value of your catalog. Our belief is that streaming is going to continue to grow over the next decade, and we believe that this is a great place to be. Consistent income. You know you're going to get that money every month. People aren't going to stop streaming revenue. We believe it's, in fact, recessionary proof, because if people go through a recession, they're not going to cut their Spotify subscription. They're going to listen to more music, likely stay home more music, more streaming, more video gaming. All that is good for owners of a music catalog. So it's an asset class we believe in. It's consistent, it generates returns, it's uncorrelated to the stock market, and it's based on an underlying asset that we think is going to grow in the future. Number 6, private equity. Private equity is a space that used to be reserved for the ultra rich, right? You would do venture cap or angel investing only if you had billions and billions of dollars. We believe that accessing a portion of your portfolio, a small portion of your portfolio in private equity makes sense. So you buy companies prior to going public, incredibly stable income stream. If you can get a whole whack of these companies that are each generating profit, the fund as itself can generate those profits and distribute them to the unit holders. The fund is valued as a multiple of that revenue. And the plan is typically, once the revenue grows, you can then either IPO that or sell it as a group to another buyer and increase the multiple. So by accumulating these companies that are generating revenue, diversifying across a whole bunch of different sectors, you get this chunk of diversified private revenue that now has a higher multiple, which you can sell or eventually take public. It works, it's diversified, and it's a great add-on. Maybe 1-2% of your holdings. Makes a lot of sense to own some of that in your portfolio. All right, now if you're gonna start investing in alternative assets, make sure 1, you understand what you're doing. 2, you're working with a fiduciary, a portfolio manager like myself or someone else. And 3, you're not impacting your financial plan, your liquidity needs, or your current economic situation. A lot of these alts might have reduced liquidity. Some of them might have daily, weekly, monthly, quarterly liquidity. Some might have restrictive covenants. Some you might not be able to sell for a while. There may be penalties if you're selling early. It's incredibly important that you work with a team that does this, understands this, knows this inside out. Because the last thing you want is for you to make some investment decisions based on a video and then you negatively impact your life and your retirement plan. Be smart about it, guys, okay? Work with us, speak to rob.com. We'd love to book that no obligation consultation. Thanks for tuning in, guys. See you in the next video.